Welcome to the August 2025 Evergreen Asset Allocation Committee meeting. Without further ado, let's start the meeting with an economic update by Mav. Economic update: labour market dynamics and inflation pressures in the US and Australia. Labour market supply shock and economic implications. MAV presented an analysis of recent US employment data, emphasising that the dramatic weakness in non-farm payrolls represents a labour supply shock rather than a demand-driven recession. The July non-farm payrolls figure came in at 73,000, significantly below the consensus expectation of 110,000, with the previous 2 months' data revised substantially downward. MAV noted that May's figure was revised from approximately 144,000 to 19,000, whilst June was similarly weakened, 147,000 to 14,000. Despite these concerning employment figures, other economic indicators remained relatively stable, with the unemployment rate rising modestly from 4.1% to 4.2% and core capex, an indicator of business investment, remaining flat rather than declining precipitously. The participation rate experienced a dramatic decline, which MAV identified as the key explanatory factor for the employment weakness. This reduction in labour force participation, rather than mass layoffs evidenced by initial unemployment claims data, suggests workers are leaving the labour market entirely. MAV attributed this phenomenon to the Trump administration's migration policies, noting that the US experienced negative net migration for the first time in over 50 years. Supporting economic indicators contradict a recessionary scenario, with capacity utilisation showing only modest softening, the savings rate maintaining 4.5%, earnings growth continuing at around 4%, real retail sales holding steady, and real GDP maintaining 2% year-on-year growth in the first half of 2025. Federal Reserve policy response and market implications. The labour supply shock has prompted expectations for Federal Reserve, the Fed rate cuts, with markets pricing a 25 basis point reduction in September and a small probability of a 50 basis point cut. Mav expressed concern that the Fed looks likely to commit a policy error by cutting rates when economic fundamentals do not warrant such action, particularly given emerging inflationary pressures. Treasury Secretary Scott Bessent's suggestion of 150 to 175 basis points of cuts was characterized as incredibly reckless given the economic backdrop. Mavi also noted the longer-term implications on economic growth and earnings growth from a cessation in labour supply growth. Zero net migration will stifle US growth in 2025 and cap LT growth potential and house prices. Mavi speculated that it may take some time for markets to get used to lower expectations around non-farm payrolls, and that somewhere between 0 to 50,000 jobs growth per month might now represent the break-even or equilibrium number of jobs for a steady-state labour market. Market positioning reflects extreme valuations, with the S&P 500's quality factor ranking in the 94th percentile relative to the past 30 years, whilst valuation and dividend yield metrics appear historically cheap. Goldman Sachs data indicates that quality stock premiums are approaching levels last seen during the pandemic surge, though not yet reaching tech bubble territory. The equal-weighted S&P 500 and mid-cap 400 indices trade closer to median valuations, suggesting potential outperformance if rate cuts materialise. Kingsley Jones warned of bubble conditions emerging, drawing parallels to the 1998 long-term capital management crisis response, where Fed rate cuts triggered an extended period of excess liquidity and market euphoria that lasted approximately 18 months. Inflation dynamics and tariff impacts. US headline inflation reached 2.7% in July, with core inflation rising to 3.1% from approximately 2.9%, trending in an unfavourable direction. MAV identified core goods inflation as the primary driver, moving above the zero baseline that characterised the pre-pandemic period. This increase is attributed predominantly to tariff-induced price pressures, with inventory front-running by businesses temporarily shielding the full impact of tariffs to date. Ron Temple's estimate suggesting core CPI could reach 4% was highlighted as a significant risk scenario. Data quality concerns were raised, with 35% of the CPI basket now being imputed compared to 30% previously and approximately 10% a year ago. This increased reliance on statistical imputation, driven by budget cuts to data collection agencies, potentially reduces the reliability of inflation measurements. MAV projected inflation exceeding 3% by year-end due to tariff impacts unless a recession occurs. The combination of potential rate cuts during an inflationary period could create conditions for either a market bubble followed by severe correction, or a stagflation-like environment with rising bond yields despite equity market strength. Australian Economic Outlook and RBA Policy. The Reserve Bank of Australia has downgraded its medium-term productivity growth assumptions from 1.0% to 0.7%, reflecting structural challenges facing the Australian economy. This productivity downgrade, combined with potential labour supply constraints, poses risks to GDP growth and real wage progression. MAV anticipated RBA rate cuts in November and February, contingent on US Federal Reserve actions and domestic inflation developments. Australian market valuations present concerns, with the All Ordinaries reaching 20 times earnings and dividend yields falling below 3.1% for the first time since the 1990s. Fundamental metrics suggest the market is approximately 25% overvalued relative to the long-term average yield of 4.1%. Recent resource sector strength, driven by recovering lithium prices and stable iron ore prices around $100 per tonne, contrasts with declining energy prices. Kingsley Jones noted positive momentum in battery minerals despite still depressed lithium price levels, whilst precious metals maintained support from continued central bank purchasing. The Australian market's elevated valuations increase vulnerability to external shocks, emphasising the importance of diversification strategies given the substantial potential for correction if adverse events materialise offshore. Orbis Emerging Markets Equity Update. Market performance and historical context. Vern Dupreez presented a comprehensive analysis challenging the perception that developed markets consistently outperform emerging markets. Historical data from the MSCI Emerging Markets Index, launched in 1988 with 10 countries and now encompassing 24 countries across Asia, Latin America, Eastern Europe and Africa, with approximately 1,400 constituents, demonstrates that emerging markets have actually outperformed developed markets over the full period since inception. However, this outperformance was concentrated in the first 20-year period, with the BRICS nations serving as primary contributors during the initial surge from 1988 to approximately 1998. The narrative shifted dramatically from April 2010 to present, where emerging markets delivered only 3% per annum returns compared to 10% per annum for developed markets. This 15-year period of underperformance has created widespread investor apathy towards emerging markets, despite the longer-term historical evidence suggesting cyclical patterns of under- and outperformance. Dupreez emphasised that investors focusing solely on the post-2008 period missed the broader historical context, noting that emerging markets experienced significant drawdowns in the late 1980s and 2000s before periods of substantial outperformance. The analysis revealed that emerging markets have outperformed developed markets in 2 out of 4 major US bear markets since 2000, contradicting common assumptions about relative performance during market stress. Additionally, volatility differentials between emerging and developed markets have converged over time through a running 3-year analysis of stock price movements, making emerging markets potentially more attractive to risk-conscious investors than historically perceived. Portfolio allocation and exposure analysis. Dupree's highlighted significant underrepresentation of emerging markets in global portfolios, despite these markets accounting for more than half of global population and approximately one-third of global GDP. The MSCI All-Country World Index allocates only 10% to emerging markets, suggesting substantial underexposure relative to economic significance. More concerning, analysis of the top 10 actively managed global equity funds popular with Australian advisors revealed even lower emerging market exposure at approximately 6%, with only 2 funds maintaining overweight positions and half holding zero or near zero allocations. This underexposure extends to currency positioning, where many emerging market currencies currently trade at undervalued levels relative to the US dollar compared to historical averages. The analysis suggests potential additional upside from currency appreciation over time, providing an additional return driver beyond equity performance. However, Dupree's acknowledged limitations in providing specific performance attribution for the 2 overweight active managers. Noting this would require further analysis of their stock selection and active positioning decisions. The concentration risk in global portfolios has become particularly pronounced when applying market capitalization weightings, with US mega-cap technology stocks dominating allocations despite apparent geographic diversification. Using uniform manifold approximation and projection techniques to map stock correlations over the past 3 years, the presentation demonstrated how market cap weighting creates substantial concentration in US equities, particularly orange-coded megacap positions, despite superficial diversification across regions and sectors. Risk assessment and governance challenges. Several structural risks characterize emerging market investing, particularly around corporate governance and state ownership. Dupree's presented compelling evidence of earnings dilution in Chinese markets, where companies achieving 10% earnings growth translated to significantly lower earnings per share growth for shareholders due to excessive share issuance and poor capital allocation decisions. This contrasted sharply with US markets, where company revenue growth of approximately 8% translated to similar earnings per share growth of 8%, demonstrating more disciplined capital management. State-owned enterprises represent a higher proportion of emerging market indices compared to developed markets, creating governance challenges where shareholder returns often rank secondary to other policy objectives. The heterogeneous nature of emerging markets compounds these risks, with GDP per capita variations ranging from Qatar at over 30 times that of India, compared to Ireland's 4 times multiple over Portugal in developed markets. This dispersion indicates vastly different development stages and risk profiles across emerging market countries, suggesting passive broad brush approaches may inadequately capture opportunities or manage risks. In theory, an active manager could control for these risks. Geopolitical instability presents elevated risks currently, with recent months generating numerous headlines around trade disputes, armed conflicts, and policy uncertainties. However, Dupree's argued that geopolitical tensions often create buying opportunities for investors capable of looking beyond short-term uncertainty. The analysis revealed a loose correlation between GDP growth and stock market returns, with markets like Brazil, Chile, and Mexico delivering superior returns compared to China and India, despite lower GDP growth rates, suggesting country-level economic growth does not necessarily translate to equity market performance. Investment opportunities and valuation metrics. Current emerging market valuations present compelling opportunities, trading at approximately 13 times earnings compared to US markets at significantly higher multiples, representing roughly a 60% discount on price-to-earnings ratios. This valuation gap approaches levels last seen during the Asian financial crisis of the 1990s, but without comparable financial distress or broad-based crisis conditions. Historical analysis demonstrates a clear inverse relationship between valuation multiples and forward-looking returns, with current US market positioning around 35 times suggesting potentially zero or negative forward-looking returns based on historical patterns. The same methodology applied to emerging markets trading at 13 times earnings, suggests potential high single-digit forward-looking returns, creating a possible double-digit return differential over the next 10 to 15 years. This valuation analysis forms a core component of Orbis's investment thesis, supported by historical evidence of sharp emerging market recoveries from similarly depressed valuation levels during periods of sentiment shifts. Active management approaches in emerging markets offer additional opportunities, with the ability to identify secular compounding companies occurring twice as frequently in emerging markets compared to developed markets. Dupree's presented Orbis's active emerging market strategy as trading at lower price-to-earnings ratios than both emerging market and world indices while maintaining superior revenue growth and quality metrics. This active approach delivers what he characterized as more business performance for meaningfully less price risk. Positioning holdings far from crowded areas of typical global portfolios to provide true diversification benefits. The presentation concluded with performance attribution, showing that while passive emerging market strategies have lagged developed markets since 2006, active stock selection has successfully capitalized on alpha opportunities, with Orbis's strategy keeping pace with developed markets despite underlying emerging market headwinds. Given current starting valuations, these headwinds could potentially transform into tailwinds over the coming 10 to 15 years, supporting the case for increased emerging market allocation through active management approaches. PM Capital Global Equities Investment Update. Global economic restructuring and deglobalization trends. Kevin Bertolli outlined PM Capital's focus on long-term structural trends spanning 5 to 20 years, emphasizing three primary themes: global deglobalization, European economic revival, and commodity scarcity security. The presentation highlighted a fundamental shift in global economic dominance, contrasting the US-dominated world in 2000 with today's China-centric trading relationships. Bertolli noted that China became a major trading partner for most global economies following its WTO entry in 2001, leveraging Western nations' desire for lower production costs to develop the world's second-largest economy. However, this economic strength has translated into global military and political influence. A Lowy Institute survey demonstrated public recognition of this shift, with over 50% of respondents expecting China to become the world's biggest superpower and technology leader within 10 years. Bertolli identified Trump as recognizing these issues, implementing tariffs that represent historically significant levels over a 200-year period. The proposed 2024 election tariffs marked a substantial escalation from the 2018 measures. However, initial tariffs merely redirected manufacturing to other Asian countries like Vietnam, Cambodia, and Bangladesh, prompting broader global tariff proposals. The deglobalization trend generates substantially higher business costs across multiple sectors. Morris Chang, founder of Taiwan Semiconductor, initially estimated 50% higher costs for US chip production, later revising this upward significantly. Battery supply chain reconstruction requires hundreds of billions of dollars over several decades. The iPhone supply chain exemplifies these cost implications, with domestic US production potentially increasing costs from $1,000 to $3,500 per device. PM Capital identified companies like Siemens, which trades at 17 to 18 times earnings while growing at double-digit compound rates, representing a significant discount to US peers. Siemens enables global reshoring through factory automation products and software, addressing labor shortages identified by CEO Roland Busch. European economic revival and banking sector transformation. European economic revival represents PM Capital's second major investment theme, driven by geopolitical shocks including Trump's re-election and the Russia-Ukraine conflict. Bertolli referenced Emmanuel Macron's November 7th speech, characterizing the global economy as comprising herbivores and carnivores, with Europeans as passive herbivores deferring economic decisions to the US and China, while Americans and Chinese represent the active carnivores. This recognition has prompted European leaders to assume greater responsibility for internal issues. Germany exemplifies tangible policy changes with a $500 billion fiscal expenditure package. Defence spending increased to 3% of GDP and substantial grid infrastructure investment through 2030. Critically, deregulation initiatives target red tape removal for small and medium enterprises, alongside corporate tax rate reduction ambitions from 30% to 25%. These policy shifts address long-standing growth impediments through regulatory reform and tax competitiveness. European banking sector consolidation presents significant opportunities, with four key headwinds transforming into tailwinds. Interest rates rising from zero levels, low growth improving from 15 years of anemic performance to 2 to 4% in particular markets, regulatory support, and market consolidation. Spanish banking market concentration increased from 40%, top 5 banks 2007, to over 70% currently. Irish banking concentration proved even more dramatic, with the top 2 banks expanding from 38% to 3/4 market share. PM Capital anticipates that this consolidation trend will continue, with regulatory support for healthy banking systems driving economic growth. Current European banks trade below regression line valuations compared to developed market peers, despite improving return on tangible equity metrics. Infrastructure investment and technical services positioning. PM Capital's European strategy extends beyond banking through infrastructure and technical services investments, particularly SPE, a French engineering and technical services provider. SPE positions itself as an enabler of European megatrends, including infrastructure investment, defence spending, energy grid transformation, and digital transformation initiatives. The company provides technical expertise to regional, provincial, and central governments for project planning and lifecycle management across these strategic areas. SPE demonstrates consistent operational performance with 6% organic compound annual growth rate over 10 years, expanding to mid to high teens growth including acquisitions. The business model leverages skilled labour intensity aligned with strong structural trends, trading at approximately 15 times earnings. This positioning capitalises on European governments' increased infrastructure, spending commitments, and the technical expertise requirements for complex transformation projects. The company's involvement spans multiple government levels and project types, from defence infrastructure to energy grid modernisation, providing diversified exposure to European economic revival themes. SPE's project management capabilities and established government relationships position it favourably for sustained growth as European infrastructure investment accelerates. PM Capital views this as representative of the type of enabling businesses that will benefit from Europe's transition toward greater economic self-sufficiency and infrastructure modernisation requirements. Commodity security and resource investment strategy. Commodity scarcity and security considerations form PM Capital's third major theme, with resources increasingly used as leverage in economic warfare amid global decoupling. Recent examples include tariffs on copper, critical minerals as bargaining instruments, Chinese restrictions on enriched uranium, and nuclear energy's importance for future energy security. This creates commodity market disruption and emphasises security requirements for strategic materials in economic transitions. Market dislocations demonstrate these dynamics, with London Metal Exchange and US copper prices historically trading closely together until significant differentials emerged around Trump's copper tariff decisions. This differential subsequently closed when more widespread copper tariffs were abandoned, illustrating commodity market sensitivity to geopolitical developments and policy uncertainty. The investment opportunity emerges amid a decade of commodity sector underinvestment, coinciding with new demand drivers from ESG transition requirements and artificial intelligence infrastructure needs. Analysis of top 10 global commodity companies' capital expenditure over 15 years reveals apparent increases from 2017 lows primarily reflect project inflation and higher extraction costs rather than meaningful output expansion. Grid transformation requirements particularly highlight demand intensity, with transmission and distribution investment needs between 2031 and 2040, requiring double the 2024 to 2030 levels to achieve net zero emissions targets. Moving on to the final part of the AAC, where the panelists discussed today's presentations and decided on a portfolio strategy. The committee examined the current monetary environment, with MAV providing detailed analysis of money supply dynamics in Australia. The committee noted the significant acceleration in broad money supply growth since February's rate cut, driven primarily by business credit growth of approximately 9.5% over the past 12 months and substantial increases in personal credit. MAV highlighted that this expansion reflected genuine behavioural changes from interest rate-sensitive borrowers, distinguishing it from base money increases that might not translate into economic activity. The committee discussed the implications of this monetary expansion for future policy, with MAV expressing the view that only 1 or 2 additional rate cuts would be necessary, taking the cash rate from the current 3.6% to approximately 3.35% or lower. The committee noted that this level would be close to Australia's neutral rate and that further cuts beyond this point could prove counterproductive. The committee also acknowledged that the extent of future rate cuts would likely depend on US Federal Reserve actions, particularly if the Fed cuts rates in September, but then pauses due to inflation concerns. The committee agreed to adjust the growth defensive allocation from the current positioning to 62%-38%. Representing a modest shift toward growth assets. This decision reflected the committee's assessment of the improving monetary backdrop and bias toward policy easing across major markets. Within the growth allocation, the committee agreed to increase domestic A-REITs exposure by 1% and international SMID by 1%, funded through a combination of cash reduction, 1%, and a decrease in mega-cap international equities exposure, 1%. The committee also refined its duration positioning, maintaining its preference for domestic over global duration exposure while shortening the overall duration profile. Specifically, the committee agreed to reduce Australian duration exposure from 12% to 10%, while increasing short duration exposure from 2% to 4%. This adjustment reflected ongoing concerns about long-end Australian yields being influenced by US Treasury movements, while positioning the portfolio in the shorter end of the domestic curve where the committee saw better risk-adjusted opportunities given the expected rate-cutting cycle.